Okay, I spoke about this at last month's meeting, and it's very timely at this point in time because what this does is it takes the top 10 stocks in the NASDAQ. So if you look at the NASDAQ index, there are 32 stocks in that index, and the top 10 make up close to 50% of that index. We are going to have a rebalancing of that index, and a new order is coming out on the 24th of this month. And instead of them having a 50% presence for the top 7, they call the Magnificent 7, they are going to limit them to 38.5%. So some of them are going to have a downgrade and some of them are going to be upgraded. So what I did is I went back to 2020 and I put together what these were for all that time frame. And I'm not going to go over the previous years. I'm only going to show what happened in terms of this time. So UP is under pressure, UPT is uptrend, and C is for correction. And what we have at this point in time, what we have at this point in time is we started out the year at 39.2%. We made a high on 317 at a time when we were in correction of 46.5%. Pulled back a little bit since that point in time. And you can see to the left here, I have dailies going back to May 26th. We have been in a solid uptrend all this period of time. The highest high we made was on June 12th. That was at 51.4%. We pulled back during that period of time, and then we try to retest that high on June 22nd. We got to 50.1. If we go further down on the slide, what we'll see is that we then went lower to 45.5%. We went lower in terms of the totals. And if we look at where we were the previous week on 6/23, we were at 50%, moved down to 49.7, back up to 50%. And then at the end of last week, we need to go down just a hair longer. We were at 49.5%. So remember, we made a high of 51.1 earlier, back in June, and we are not anywhere near there at this point in time. What we're having is some of the lesser funds, the lesser stocks seem to be adding a 0.1 or whatever, and some of the leaders are losing a 0.1 or 0.2 on a regular basis. So it may balance out, but it shows that some of the leadership could be a little bit stronger at this point in time. And I think it's probably because some of the index funds are going to be selling off some of their position because of the rebalance. So we'll see what happens with that. But, you know, I'm keeping this up and I will let you know what happens. Moving on to the next slide. Okay, what I do here is I look at where we are in terms of the 5-day, the 10-day, the 20-day moving average. And I basically count the up and down days for those indexes. And you can see we were in correction at the beginning of the year, and those numbers were all low. If the number is higher than 5, it gets a green bar. If it's lower than 3, it's going to get a red bar. So you can see that on 210, the NASDAQ made a low for the 5 days. It had 1 day up and 4 days down, 4 days up and 6 days down for the 10-day. And for the 21-day, we were even at 10 and 10. The Dow was a lot less strong, as was the S&P, with 2 and 3 for the 5 days and 4 and 6 for the 10 days. So We went under pressure the week of the 24th of February. We retested the low that we made for the 5 days on 4/14 for the NASDAQ. We had 1 day up and 4 days down, 3 days up and 7 days down, 9 days up and 11 days down, which was lower than it was from the previous time around. You can see that we went back under pressure again for 2 weeks, and we retested again, and again we made 1 day up and 4 days down for the 5 days for the NASDAQ. Moving on, you can see that for the Dow on the week of 5/10/12, we had no days up and 5 days down for the 5 days, and 1 day up and 9 days down for the 10 days, 6 days down and 14 days down for the 20 days. So you can see that the Dow was the weakest of those, and it retested again on 6/23, and again it made no days up and 5 days down, but for the 10 days, those numbers improved at 4 and 6 and 10 and 10. You can see that for the NASDAQ, we had a big move forward, or the S&P had a big move forward, and for the 20-day, it went up to 13 and 7 for 2 weeks in a row for 6/16 and 6/23. Same thing happened for the NASDAQ, 13 up and 7 down for the 20 days. And you can see that for last week, the numbers were not as strong as they were before, having made highs earlier during that period of time. But, you know, the market is still moving forward, and one of the things that also happen at the end of the month is you have window dressing for the mutual funds. And so you tend to have more selling at that point in time. And what we also have at this point in time is you have the dregs of the 3 indexes coming out with earnings, very few earnings, 2 or more a day, you know, on the upside, and, you know, maybe an equal number or whatever on the downside. But we started with the banks last Friday, and next week will be the highest number of earnings that come out for this period. So moving on to the next slide. Okay, we can go up to the previous just a little bit here. Okay, this shows the 33 industry groups, and I have them alphabetized rather than in rank order. This is the start of the year, and this is what their returns were for the year, the previous year, 2022. So all of those that are in blue were highs, new highs that they had made for that point in time. So if we move down the ranks, and you will see on this slide that there are many dark greens, that means that those particular groups made their high for the year, and it is still their high for the year, and that happened in the first 3 months of the year. What you see on the bottom here is how many sector leaders there are, and then I count up how many groups were positive in terms of their year-to-date return and how many were negative. And we had the most this particular week, where we had 29 groups up and 4 down, and for the day we had 20 up and 13 down. So, you know, that's showing that the market is really strong with numbers like that. Then moving on to the next quarter, ending in June 30th, one of the things that we see is that aerospace made its high. We'll see that electronics made its high. You can see that computers made a high 3 weeks before that. Insurance, leisure, machine, and miscellaneous all made highs on June 30th. Food and beverage made a high back in May, and media made a high back the second week of June. You can see that if we continue down on that particular slide, you can see that mining didn't make a high during this period of time. Miscellaneous made a high, retail made a high for the year, and that was probably in early, end of April, early May. And then you can see that software made a high 3 weeks prior to the end of the quarter. And the highest number of sector leaders that we had was this particular week when we had 8. And you can see that for those 2 weeks, we had 24 of the groups that were positive out of the 33. But earlier in that quarter, we had 26 that were positive. So moving on to the last 2 weeks, what you see is that apparel, autos, building, business services, chemicals, chips, computers, internet, leisure, real estate, they all made highs for that week, which was a lot. So when you look at the ones that had made previous highs, and this column in here shows the year-to-date high for all of those groups. And you can see here for building, 24.55% was the high, and that high was made last Friday. You can see, the same thing for apparel. Apparel made 15.47. That's what it made on Friday. So I put this here so you could look at it. What I want you to do with this is I want you to take this information here, compare it to where it was on the first slide, showing what the year-to-date return was for last year. We are bumping up against those highs. And once you make those highs, you either stay there or you break down. Or, I think we're going to have a hard time continuing to go up. I think the market will go sideways before we have another move up again, but time will tell. It really depends on what happens with earnings. Moving on to the next slide. Okay. What I did was, and I talked about this many months ago, the put to call premium and the put to call volume. And you can see that the put to call premium was at a low here of 0.46 on February 3rd. That was also a 1-year low. The 1-year low was 0.46 going back to 6/16 of 22. You can see that we made a high in here, a 107. You can see the put to call volume made a high of 115 back here in March. Then it came down to 0.8, not that far off what that particular low was. And if we continue to go further down in the chart, one of the things that you see is that we made 0.47, the previous low being 0.46 on 2/2. We bested that same low of 0.46 the week of June 2nd. The low was 0.46 both on June 2nd and February 2nd. We went a little bit higher, a little bit lower in here, and that was actually the low of 0.44 on 6/9. We actually made a lower low than that on June 16th of 0.27. And then we went to 0.22 twice on June 30th and July 14th of 0.22. Now let's go back up to the top of that slide to see what do these numbers represent. The put to call premium. So that meant that there were fewer puts that were being made at that point in time and more calls. So people were betting that the market was going to go up rather than the market going down. That's why you had a higher number in here when the market was in correction, because more people were buying puts than were buying calls. Okay, enough of that slide. Moving on to the next one. Okay. What I did was I put a calendar together for the rest of the year, and I talked about this last meeting, and I talked about being in the stacked indexes. The 21-day has to be ahead of the 50-day and has to be ahead of the 200-day. So the week ending June 30th, the 200-day was at 9/14 of 22. The 50-day was at 4/27 of 23. The 21-day was at 6/8. What I did was I took the calendars for the last several years and I circled all of the holidays because the market is closed on the holidays. So I had to move forward by a day or so if we had a holiday, because I couldn't just tack 5 days onto it, even with the weekend, because it wouldn't work out because of a holiday. Like we had a holiday in here for the 4th of July. So you can keep this list and you will see where we are in relationship to it. And you will see whether or not we're still above the 21, the 50, or the 200-day. It goes all the way down to the end of this year. And I already started on the calendar for next year. So I just didn't put it in 21 days, but I have the 200 and the 50-day average already penciled in for 2024. So you can keep that and see whether or not we're doing what we're supposed to be doing. Okay, moving on to the next slide. Okay, this is tidbits, and basically, I thought this was very interesting. 780,000 Chinese hold assets in excess of $1 million, but 5.37 million Americans do. So, we may have more trillionaires in China, but we have more millionaires in the United States. Mexico had improvements of over 76% after NAFTA too. We made that trade agreement with Canada and Mexico. Asia had improvements of 66%. The US had improvements of only 22%. So Mexico was the clear winner here. In terms of the economy, Japan is now number 1. Asia is number 2, and the world is number 3. The Silk Road debt that China put forward to put in all of these high-speed rails and roads, etc., are coming due for $240 billion. And they're going to have to do increased bailouts because the countries that they put this money into cannot pay them back. And that was what China's plan was all along. They didn't expect to be paid back. They want to be indebted to them so that they can take over more countries. So here's a little tip about the US deficit. Okay, lesson number 1. Here's the US tax revenue. And our revenue is less than the federal budget. So we need to put forward this much debt just in order to meet the budget. So that's more than half of what our tax revenue is. And it's a little less than maybe 40% of what our federal budget is. So our national debt at this point in time is humongous. And even with the recent budget cuts, we barely, put a dent in what our debt is. So we're going to remove 8 zeros and pretend it's our household budget. Our household income is going to bring in $21,700, but we're going to spend $38,200. So the new debt we're going to put on our credit card is $16,500. Our outstanding balance on the credit card is going to be $142,710, to which we made budget cuts of $38.50. That ain't going to do it. Ain't going to do it. So let's go on to lesson 2. And lesson 2 says, Here's another way to look at the debt ceiling. Let's say you come home from work and find that there's sewage backed up in your neighborhood, and your house has sewage all the way up to your ceiling. What do you think you're going to do? Are you going to raise the ceiling or are you going to remove the sewage? We need to do something in Washington about the sewage. We can't keep raising the debt limit and expect that we're going to be able to pay the deficit. We can't do it. We cannot do it. So the Labor Department reported that the US import prices in May for goods from Hong Kong, Taiwan, and South Korea have fallen 6.3% in the past year. That's good. And this price deflation should show up soon in the inflation data. Economic weakness should also push bond yields further down, especially as evidence of lower inflation emerges. Expect upward GDP revisions. Another factor causing economists to revise their second quarter GDP growth is the fact that the Commerce Department announced on Wednesday that the trade deficit in May declined 6.1% to $91.1 billion as imports dropped 2.7% to $254 billion and exports declined 0.6% to $163 billion. Okay, so let me get this right. We're exporting less than we did before. That's not good. We need to export more and bring in more dollars. The leading sectors for the week ending 6/30 of 2023, for the first time in the calendar year, all S&P 500 sectors rose last week. Even real estate and utility sectors gained in the face of Powell and the bond market, seeming to be pretty convinced that another quarter-point rate hike on July 26th FOMC meeting is in the offing. That is next week. And yes, they will raise again. So moving on. This shows the real estate and energy stocks actually lead all 11 market S&P sectors last week, up 5% each. So this is what these particular sectors did last week. Energy did really well last week, and real estate did really well. There is something new that came out in mortgages where what you can do is you can either get the seller to decide that they're going to pay part of your mortgage, so that instead of having to pay, say, 6.5%, you're going to pay a lower rate for the first 2 years of the mortgage. They're going to put money into an escrow account, and at the beginning of the third year, your mortgage rate is going to go up to whatever it was when you took out that mortgage, which would be 6.5%. So it may go down to 6, and then it may go down to 5.5 for 2 years, but then it goes back up again. We still have an inverted yield curve as measured by the 2-year note and the 10-year note. The Treasury yields have gotten more inverted of late, registering 106 basis points at the last count. Even at this, many bond experts are saying that we are still in lucky territory, as this is not yet a sign of an imminent recession. This is not yet a sign of an imminent recession. What would be more troubling sign would be that the curve sharpens steeply after being deeply inverted, which typically happens just before or in the early stages of a recession. Let me read that one again. What would be a more troubling sign would be that the curve sharpens steeply after being deeply inverted, which typically happens just before or in the early stages of a recession. The onset of the 1990, 91, 2000, 2001, and 2007 and 9 recessions are good examples of that yield curve steepening before the recession. See the chart below. Even though the 2020 recession was mandated by the government shutdown and therefore very different than a more normal recession, the yield curve did steepen before that recession also, and it's almost like the bond market sniffed out the pandemic before most investors did. So here you see, going back to 1980, what that yield curve did. And here we are at this point in time. We were inverted there. We were inverted here. We were slightly inverted here, but we're inverted quite substantially here. Not as low as we were here, but we could go lower. We could go lower. Another measure of inversion is the 3-month 10-year spread, which is at a 162 basis points at the last count. Every time people brought the 2-year, 10-year spread inversion in 2022, Jerome Powell would cite the 3-month 10-year spread as proof that the yield curve was not inverted. Well, that was before he inverted that curve also. In 2006, the last rate hike was in the summer of that year, before the recession triggered by the tightening cycle started in December 2007, an 18-month lag. So moving on, the S&P equal weighted index had a great June. And this is basically the equal rated. See, the equal rated was going down. For the month of June, it has gone up. And, that's a good sign. It means that the market was broadening out, and small caps and the Russell, et cetera, were all being a part of the market uptrend. Moving on down the slide. Today's focus on how to pick great stocks using stats and probabilities. It's a holiday weekend and the market will be quiet, so it's a perfect time to learn a lesson. It is not the essential lesson. First, it's time for another stat. I thought this one was really, really interesting. The best performing 4% of listed companies provide the net gain for the entire U.S. stock market since 2026. The best performing 4% of all listed companies provide the net gain of the entire U.S. stock market since 1926, as all other stocks collectively match the Treasury bill. This is from a summary of a paper written by Heinrich Bessenbinder entitled, "Do Stocks Outperform Treasury Bills?" Out of 26,000 stocks studied from 1926 to 2018, when the paper was written, roughly 1,000 stocks accounted for 100% of the gains of the stocks above the treasuries. And this is what it looks like. Okay? This is the rest of them. So perhaps even more fascinating is he found 1% of the stocks accounted for 50% of the market gains above the treasuries. What if I told you that picking stocks is as simple as an equation? The formula is, here it is, but we knew that all along. Superior fundamentals, strong technicals, big institutional support. Remember, when Keith does the stocks, he's always telling us whether or not mutual funds are invested and how many A+ funds are invested in the stocks, and the best stocks. So for superior fundamentals, we're looking for double-digit percentage for the 1 and 3 year sales and earnings growth, below 25% debt versus equity ratio, double-digit % profit margin. Strong technicals generally trade near 52-week highs. They trade near interim highs and are in the leading sector or leads their sector. There's big institutional support. Exhibit unusual institutional buy signals. Rank on our top 20 report. Ideally is an established outlier repeatedly on the top 20. This is how to whittle down 6,000 stocks to 1,400 in consideration, and then finally down to 20 powerhouse candidates each week. That's 20 out of 1,400 stocks, or 1.4%. So Keith and I hope that, we gave you some of those stocks for today's meeting. So this is the big money index. And the big money index basically shows, that money is still going into the stock market, and that's a good thing. And you can see the gain, for several different time periods, and those gains are fairly substantial. You see we're at the 90% mark for some of them. This was data as of June 29th, and remember, the market made a high, around the end of the month at, I think it was 51.1% for the top 10 stocks in the NASDAQ. If we move down, this is due not only to buying, whoops, can we make that a little bit bigger? This is not only due to buying, strengthening, but also selling stocks as well. If the, I can't read that top line. If we could go up just a hair on the slide. Okay. In the chart below, notice the green staying strong while the red shrinks. The big money index, BMI, gives us a great idea of overall money flows. Over a soft previous week, the BMI is once again on the rise. So I'm going to talk about quantum computing because I thought this was really interesting. And you want to take advantage of this information as well. Google's quantum computer. The future means quantum computers. And with that future comes significant concerns as well as opportunities. Quantum computers are able to process information using qubits as opposed to classical computers that use bytes. Effectively, quantum computers go through reams of data in a fraction of the time of a current computer. For example, quantum computing can perform a calculation in 200 seconds that would take the classic computer some 10,000 years to perform. 200 seconds to 10,000 years. That's great, but this quantum leap in processing speed holds the possibility of making current encryption programs effectively useless. That is a big, big worry. Big, big worry. It's going to show that maybe this stock is really moving ahead and everybody wants to go into it, but, we're not going to have any way to protect ourselves. So again, this is showing the big money stocks, buys and sells. If we go down a little further into this slide, and you can see that the green is upward buying and the red is downward. And you can see that the green bars are much higher than the red bars were in here, meaning that the market has had an upward trend rather than a downward trend. Moving down. Lastly, we can see what sectors are getting bought as well. Looking below, we see growth areas like industrials, discretionary tech, and healthcare are bid. Together, these four sectors account for 65% of all buys over the last week, including Friday. 65% of all buys. Industrials, discretionary, tech, and healthcare. Okay, moving on. According to the Brookings Institute, 50 out of every 100 blue-collar jobs will be replaced by AI. 50 out of 100 blue-collar jobs. As a truck driver, you can earn about $80,000 a year in the U.S., enough to support a family in most small to mid-tier cities, even with today's inflation. Well, AI is about to push that salary down to a big fat zero. Think about what that will mean for the 3.5 million truck drivers in the U.S. It's the same story for warehouse and manufacturing workers. Amazon already has more than 100,000 AI-powered robots in their warehouses. Soon, I believe there will be virtually no humans there. Walmart, the largest private employer in the U.S., said recently, in the next 3 years, it will use AI to automate a large number of its stores. They said 65% of the stores and 55% of their fulfillment centers will be fully automated. Think about that. If they're going to be automated, what is going to happen to those people who had jobs before? They are not going to have jobs anymore. And it gets worse because this time not even white collar workers will be safe. For example, let me tell you about a study published by LawGeek, a leading AI contract review platform. It pitted 20 attorneys against the AI to identify errors in various contracts. The results: the lawyers were able to identify mistakes with 85% accuracy in roughly 92 minutes. But get this, AI managed to find errors in the contracts with 94% accuracy, a higher accuracy in 26 seconds, 200 times faster than the 20 lawyers. And the craziest part was this happened in 2018. AI's gotten better since then. So in the market, only three numbers matter. When all the dust settles, they are not PE, debt, current ratio, PEG, profit margins, or inventory turnovers. Although we all look at them, they are prices you paid for the shares, prices you received for the shares, and the time held. So I want you to put this in your treasure chest. There are over 1,700 warehouses in the United States. Less than 10% of them have robots. Logistics automation is a fast-growing segment for the near future. Robots are going to be used not just in warehouses, they are going to be used in hospitals, in operating rooms, which they're already being used, but they're going to be used to a greater extent. So I think your homework for this week is to find out what companies are in robots, and you need to be making an investment in them for the long haul because you will do very, very well. I think there's only one more slide, and that was the last one I sent you. Okay. Now, this is the Magnificent Seven. It is the top 7 stocks in the NASDAQ. Microsoft, Apple, NVIDIA, Amazon, Tesla, Meta, Apple, Google, and Alphabet. The weight as of July 7th was 12.90, 12.50, 7%, 6.9, 4.5, 4.3, and 3.7 for the 2 Alphabet stocks. This is how much their market cap was. So you can see that Microsoft has a higher percentage ranking, even though Apple has a higher market cap. You can see that NVIDIA has a lower market cap than Amazon does. And you can see that Google has a higher market cap than all of these. So it would put that in the number 3 spot. So here's what my expected changes are going to be. You know, I expect that Apple is going to be in the number 1 position, followed by Microsoft, followed by Alphabet, followed by Amazon, then NVIDIA, then Tesla, and Meta. And when the dust settles, instead of having 50% of the index, they are going to be going down to 38.4. So these guys are all going to be going down in value in terms of the percentage that they are going to be of the index. So we'll have to see on the 24th, you know, what that new number is, but that's my prediction that this is going to be the new ranking. And this, I can't tell you what the percentage is going to be, but if you take those 7 and say, okay, if we were at 50 and we're going to 38, that's a difference of 11.5%. We're going to have to take 11.5% out of these 7 stocks. Which ones are we going to take them out of? Okay, that's it for tonight. I have nothing else to say. Adios, muchachos.
Great presentation, Kopi.
Yeah. Okay.
So we should have a presentation from Talcott, and Francisco always does something at the end. And I don't know about Ron because he did not respond. So we'll see what happens there.